Welcome to this exclusive video for smart hedges only. Of late, in last 2 months, what we had found that okay, profits for different traders are totally different. Basically, because of lot of execution challenges which any trader will face in case he is trading in strategy. So we said how to overcome these execution challenges. This will be very beneficial for lot of smart hedge traders. What is happening is in a same trade, one trader is saying that okay, my profit is 67 rupees, another trader is saying my profit is only 45 rupees. So there's a huge gap, and when we have checked these things we found there are a huge amount of execution challenges and how to overcome. Let us see that. Now, in any strategy having multiple legs, the success or failure of the strategy is obviously dependent on how well it is executed. Now, for some traders, as I said, some traders making more profits because of better execution. Some traders are not able to make those kind of profits because of some challenges in the execution. So now from 1st June, we also know that margins are getting reduced. With margins getting reduced in the same capital, maybe we will be required to do multiple sets of strategies. At that time, the right execution becomes all the more important, right? So in this video I will be giving you some tips on how to execute the trades. With that, some challenges, all challenges cannot be totally removed whatever we try, right? But definitely there will be improvement in the overall execution and improvement in the overall profits of strategy traders. Now, what will happen if you have a strategy? Obviously it will have multiple legs. It can have 2 legs, it can have 3 legs, 4 legs also. Some legs will be very liquid and some legs will not be liquid. So whenever you are trading into any strategy, you need to see that okay, out of 3 legs, which leg is most illiquid, which leg is most difficult to execute, right? So identify the most illiquid leg first. We must first trade this most illiquid leg. I'll give you an example also. Suppose there is a trade wherein you are doing 8300 put buy, 8400 put sell, 96 call sell, and 97 call buy. This is an iron pounder with 4 legs. You are buying 83, selling 84, selling at 96 and buying 97. Now after seeing, first thing is okay, you will bring this to all these 4 legs to your screen and you check best buyers and sellers, and you found that okay, for 8300 put there is a difference of almost 10 rupees. Let us say the buyer is sitting at 70 rupees, the seller is sitting at 85 rupees. Whereas all other legs 84, 96, 97, there is hardly any difference. A difference of 1 rupee 50 paisa, 1 rupee 50 paisa is always okay. But let us say in this case you are able to identify that okay, it is the 8300 put which is having a lot of difference of, let us say, 7, 8 rupees or 10 rupees between buyer and seller, and I want to buy it. So what we have done is we have identified that out of these 4 legs, this 8300 leg is most illiquid leg, and this can reduce or increase my profit or my profitability of the overall trading strategy, right? If somebody is buying it at 80 rupees whereas the other person is buying in 72 rupees, so the 8 rupees difference will create huge amount of difference in the final profit also. So suppose we have identified that okay, this 8300 put is most illiquid put in this trade. We will first execute this trade. Once we have executed this trade at a proper rate, then we will do the other trades. Now how will we execute this trade, right? Again, you go to that best 5 buyers and sellers. Any platform will show you that. Suppose the buyer is at 70 rupees, seller is at 80 rupees. You punch your order with buying at 71. You become the best buyer. Suppose you want to buy this, and on the screen it is showing first buyer is at 70 rupees and first seller is at 80 rupees. So you just punch 71. Most probably what will happen, as soon as you punch 71, another order will come there at 71.05. This is basically because of all algo trading. So they have fixed rates that okay, anybody coming at this rate, my order with 5 paisa better will be executed first. Now once this 71.05 is coming to the screen, what you need to do is you just increase your bid by another 1 rupee. from 71.05, you say, okay, now my order is 72. Sometime it will happen, nobody will come and your order will execute at 72. Sometime at 72, as soon as you punch 72, somebody with 72.05 will come. You punch 73, somebody with 73.05 will come. So you have to beat this algo trader. Ultimately, there will not be a difference of more than 1 or 2 rupees. So if he has punched the order still, let us say 73. So once you put 74, there will be no order of 74.05. At that time, your order will get executed at 74 instead of 80. 74 is a much better rate, so you have to wait. Once this order of 74 gets executed, that means you have traded the most illiquid leg. You keep on increasing your order by 1 rupee till the time you are able to beat that algo trader, right? So once you have executed this illiquid leg, now you know the other three legs are pretty much liquid. There will be hardly a difference of 1 or 2 rupees. Then you can quickly go ahead and do the other legs. Now, one thing you must be very, very careful once you have executed even one of the legs out of four legs. Now, in the example, there were four legs, right? Now, if one of the legs is actually traded, actually the trade is executed, the strategy has started for you. You cannot do same things for second, third, fourth leg. You have to execute those three legs as quickly as possible. You cannot say that, okay, I will try to decrease the buying rate, or I will try to increase my selling rate, thereby trying to take more credit in the strategy. That can be really, really harmful to your trade. So we must execute the balance three legs very quickly. So for any trade, bring all the legs to your market watch before executing even the first leg. Once I bring all the four legs to my market watch and remove all other clutter on the market watch, only these four legs should be there. From there, you will come to know, okay, this 8300 was most illiquid. Let me first take care of this, and then quickly I need to trade the balance legs. Now, how to trade those balance legs? You again need to follow a logic, right? You need to follow a logical order. Now, let us say in this case, I'm giving you with this example. Once I have executed buy of put, right? So four legs are buy a put, sell a call, buy a call. Now suppose I found that, okay, buying put of 8300 was most illiquid and I need to execute it first by the method I have shown you. So you have executed, let us say, this leg at 73 rupees. Now next, what you should execute, you should immediately then execute sell put, the contra trade. Once you have bought put, now if I say otherwise, buying a put is a bearish trade. Buying a put is a bearish trade, right? So if the next leg you execute is selling a call, that is also a bearish trade. So my two legs executed are buying a put and selling a call, and these are all bearish trades. And from here, let's say market goes up. So what will happen? My sold put will be very cheap. My bought call will be very cheap. Ultimately, if I wanted to have a credit of 50 rupees in the whole trade, still I will get only 35 rupees credit, which again disturbs the strategy. So you must do the contra trade. Now, if you have done a buy put, next order you must execute is sell put, right? Okay, I think this is repeated here. Now you must execute sell put at CMP, or even you can do 1 rupee less than CMP, doesn't matter, because whatever is the best rate that will come. Suppose you want to sell a put in let's say 90 rupees, and the screen is showing you buyer at 89 rupees and seller at 90 rupees. You put 88. Even if the buyer is sitting at 89, your order will not execute at 88, it will get executed at 89 only, but you will not miss the order, right? After that, now what we have done, we have purchased a put, we have sold a put. Ultimately, this is a bull put spread, so this is a bullish trade. Now I must not buy a call first. I should not combine bullish trade with bullish trade. Buy call is also bullish, bull put spread is also bullish. Now the third thing which I should execute is sell a call, which is a bearish trade, so that I'm getting contra value also in the overall strategy. So once I have executed buy put, I must do sell put. Once I have done buy put and sell put is completed, what I will do now, I will now sell call first, and then buy a call. We should not do similar trade like sold put and purchased call. Why? Because both are same. If market moves from there, both will be they can be at a great disadvantage. They can be a great advantage also. But generally advantages never happen in markets, right? So always do a contra trade. If you have purchased a put, immediately sell a put first, then don't buy a call, sell a call, and then buy a call, right? So you must see that, okay, which trade is a bullish trade, which trade is a bearish trade. First leg I am doing buying a put is a bearish trade. Next leg of that is I will sell a put, which is a bullish trade. Got it? Now two legs are executed: buy put, sell put. Overall, this is a bull put spread. Bull put spread is a bullish trade. So third trade should be a bearish trade, which is sell a call, and then fourth trade should be buy a call, right? So we need to execute one trade, then the contra trade, then another trade, then contra trade. Like this order we should follow. Chances are we will get a good trade. So generally, if you say that, okay, you want to start a strategy with a credit of 55 rupees and you trade in this fashion, chances are you will definitely get 53, 54, 55, 56. But if you don't follow this pattern, many times it will happen. You are trying to get 55 rupees, but ultimately you have got only 45 rupees. So on the table itself, in the initial stage itself, we have lost that 10 rupees. This become very important when you are trying to earn 30-40 rupees from the strategy, right? Now, if you are doing multiple sets of the same strategy, let us say you are not doing one set of this 83, 84, 95, 96, you want to do four sets. Now, if everything is liquid, yes, you can go ahead and buy four, sell four, buy four, like that, you can do that. But if you find out that, okay, one of the trade is highly illiquid, then instead of doing all the four trades together, go one by one. If one leg is liquid, better go one by one. First execute this leg, then second leg, third leg, then other legs of the trade, complete one set of the strategy. Then again do this leg, then other legs of the trade, complete second set. Like that you need to go, because otherwise if you complete one leg in all the four sets, by the time you're doing other legs, things can move, and again the credit can get really disturbed. Now at this point you can say, who will pay more brokerage? Because most of the times you are having a brokerage which is for 20 rupees per order. So in that case, you see, yes, you are saving the brokerage, but otherwise the impact is very high. Even if your trade gets executed at 1 rupee better than otherwise, you are saving 75 rupees. So if I am saving 75 rupees, even by saving 1 rupee on the order, I am okay with giving 20 rupees. So brokerage is not important when one of the side is illiquid. If that side takes, let us say, 7-8 rupees from you, then the whole brokerage, whatever I have saved, maybe if I'm doing the trade four times, I will be saving, let us say, 60 rupees. 60 into 4, 240 rupees. But even one of the trade gives me 10 rupees less, I'm gone with 750 rupees. So don't think of brokerage in that case. If all the legs are liquid, yes, you can take advantage of that brokerage. If all the legs are not liquid, do one by one, execute the illiquid leg of first set, then execute all the other legs, then execute this for second set, first leg of illiquid, and then the balance. So that way you have to complete the four sets of the same strategy. You should not do it in one go only, right? So what is the right execution method? First execute the least liquid leg, then immediately execute contra leg. Hopefully all of you must be understanding. Then choose contra trade. First I have chosen contra leg. I have purchased a put. I am selling a put. Suppose I have purchased a call. If I purchased a call, then second contra leg will be sell a call. Then choose contra trade. Now I have completed my bear call spread. That means a bearish trade. Now I will start doing a bullish trade, bull put spread. In bullish trade, in bull put spread, sorry, bullish trade is sell put, not buy put. Buy put is a bearish trade. So I will first sell put as a third leg, and fourth will be buy put. So first execute the least liquid leg, immediately execute the contra leg, then immediately whatever is executed, whatever contra to that trade, then choose the contra trade and then finish the complete strategy. After first leg execution, next leg to be executed at better than CMP, no limit price, even better than CMP. I'm saying if you're buying a call, let us say you're trying, your buyer is at 70 rupees, seller is at 72, you punch a order of 73. If seller is standing at 72, you will still get at 72. But if you punch an order of 71, seller suddenly goes to 73, you are gone. By the time you change the order, it can go to 75 also. So just give 1 rupee extra, even if it is gone, it is gone. But at least the overall structure of the strategy will not change. In case of multiple trades, if something is illiquid, do one by one, rather than executing all 3, 4, 5 sets in one go. And in case of basket order also, if you're using that, you see basket order doesn't mean that all your trades will get executed. Then also you must see that, okay, are if you're buying something, they're taking at seller's rate. If you're selling something, they're taking at buyer's rate. That time also you must see if any illiquid strategy, illiquid leg is there, that should not be put under basket order. And once you have put the basket order, you must ensure that, okay, all the legs are executed. It may not happen that only two legs are executed, two are pending, and you are required to manually change the prices of those uh, balance two legs. Ultimately, it will destroy the premium available in the whole strategy. If in the whole strategy you are trying to pick up, let us say 65 rupees, if the trade is not executed properly, instead of 65, it might so happen that, okay, you are getting only 49 rupees. So already the 16 rupees are gone. That makes very difficult ultimately for you also to close the strategy at the right time, or even if you're closing it at the right time, your profits will be very less. So hopefully this is sorry, hopefully this method of execution all of you have understood, and hopefully whenever you're executing your next trades, you will follow this and you will be able to get the similar kind of credit what we have written in our messages, right? Thanks to all of you. Thank you.